So let's start, and then we can, if more people join, obviously we can accommodate that. So good afternoon from me. My name is Asen Chaliski, one of the managing directors at BWB. It's great to see some familiar faces. You may know me from some of the webinars we did on climate investment planning and also in some of the individual city meetings. First of all, let me congratulate all the cities that have received the label. And of course, wish good luck with all the cities that are going through the process of preparing their climate investment plans and doing the submission to the Commission. We're here to support, of course, BWB and the wider consortium through the Net Zero Cities platform. Before we go into the specifics of talking about city funds here, just to give a bit of context, what the whole city finance journey and the process that you've been through. As I mentioned, quite a few of you have prepared the climate investment plans. It was an exercise to help us get a better, and you, of course, get a better understanding of what capital is needed to reach net zero. What are different stakeholders you should get involved kind of in the process, what sectors are priorities for you, and clearly have a much better understanding of how much capital is needed where. I think most, if not all, the cities have highlighted that finance and access to capital is one of the key challenges for you to reach net zero. Other cities have, or quite a few cities have also highlighted that capital is available for some of them, but they find it challenging to deploy this capital, right? And obviously we are putting in place Cities Mission Capital Hub, which is something most of you should be aware of, to help you facilitate that process. What I can say is, capital is available. There may be additional resource down the line. And there are, of course, different mechanisms and tools that can be used to put in place to channel this capital, whether it's in the form of grants, whether it's in the form of loans or equity. The Capital Hub will help. It will be an independent entity. It will sit as a kind of a top company, which will facilitate this process. But one more specific instrument at a local level, if you like, is obviously an SPV or city funds. And that's what we're going to talk about here now. There is kind of a slight marginal difference in terms of what an SPV and what a city fund is, but I'll let colleague kind of dig into that a bit more. So that's a brief kind of welcome from me, and also setting the scene and the context in terms of climate investment planning, the Cities Mission Capital Hub, and also one specific instrument, which is the city funds. Let me now pass over to Harry, who's going to run through the specifics in terms of the city funds, what it means, what are the key considerations you should kind of look at when you're thinking about setting up a city fund, and how does it sit in the context of the wider Net Zero Cities program. Harry.
Yeah. No,
and maybe
absolutely.
We can,
and
just to ask Luke, maybe we can move the slides, please.
Yeah, so what I'll do quickly is I'll cover the agenda, what we're going to do. I'll also cover a little bit of what the topics we're going to be covering later on in some of the webinar series. Just to be clear, this is the first of many. And then after that, we've got a short introduction as to more of the sort of context behind why we're delivering this, which my colleagues Sen and Alison will also be able to deliver. But just as a quick introduction as well, I feel like I've met quite a lot of you probably on an individual basis, and I've done a few of the webinars here. But for those of you who don't know us, my name's Harry and I'm from BWB, hence the very jazzy background to identify me amongst all of the other people on this call. But lovely to see you. I've been obviously on this mission for working on this net zero mission for the last almost a couple of years with my colleagues Stem and Alison, and background in city debt and investments at a short-term level. But pleased to see you all and meet you all, and I guess obviously I'll be engaging with each of you on a much more sort of a individual basis following this. If you want to talk more about the city funds, want to discuss some of the other financing options, and as we start rolling out the City Mission Capital Hub, you'll see a lot more of me. But yeah, the plan is to cover really what the difference is between SPVs and city funds. We've been asked a lot by different partners about this, and I guess that's partly because of the large financing gap that we're seeing at a much higher level. So we'll cover SPVs, we'll cover city funds, we'll cover a little bit about the governance models and how that'll actually engage with, or what the sort of general modalities are for engaging within your city on that. And obviously there are a lot more contextual elements to it, such as the underlying, which would need a more sort of bilateral based conversation. But hopefully this can be a great sort of start to the conversation as to how we're going to be able to interact with them. So on the next slide, we've got obviously, if we see, this is the first of a multiple series of events. So we're going to be looking at things like green bonds, carbon credits. We'll also be looking at crowdfunding as an aspect, which will be later on, and EU taxonomy. I know a lot of the communications have gone out via the Net Zero Cities portal, so please, get in touch with your city advisor, get in touch with some of the organizers behind this and people behind the portal. We might be able to give you more information as to what's covered, and also there's still time to give us a bit of feedback as to the things that you'd like to get covered within these and what you think would be really useful, where the gaps in the knowledge are. So hopefully if we get a bit of feedback from this, we'll see what we found really interesting, whether it's the case studies, whether it's the use cases, or whether it's the way that they're deployed, or some of the more sort of technical aspects that people also really like delving into. So give the feedback to city advisors, let us know, and also we'll leave some time at the end for questions, so hopefully you can cover a few of them. But on that note, keep yourself on mute if you can, but otherwise leave questions in the channel. We'd also love to know where you're dialing in from as well. So leave a note of where you're, which city you're coming from, where you're in the city you're at. And we'd love to address and meet you all later on, but I'll hand it over to my colleagues, Sen and Alison, to, I guess, introduce the concept and introduce how this fits into the rest of the mission.
Super, thanks, Harry. So welcome everybody today. My name is Alison Lobb, and I too work for BWB and have been helping in terms of setting up the city's mission capital hub. So we have met a few of you, and I'm sure we'll get to meet everybody as we go through this process. Luke, maybe quickly just starting on the first slide. I'm just going to put things into context over 5 minutes, and then we will certainly move from there in terms of what the actual city fund and SPV structure looks like. So we know that there's probably a capital need of about 650 billion euros outstanding in order to get the climate plans actually implemented and up and running. That does depend quite a lot on population side, but and indeed bigger cities obviously needing a little bit more. But you can see from the middle chart that a lot of the capital needs to come from the private sector. So all of this data has come from the CCCs in a kind of combined basis to show the overall picture of what we're looking at. And indeed, what we're looking at is a big need to find additional sources of capital because there isn't enough grant funding, there isn't enough EU capital around in order to get the projects that needed to be financed. So that's why we've been asked to set up the city's mission capital hub. If we move just to the next slide, that job is definitely going to be threefold. So you can see that sort of when I look at financing across the city, there's multiple stakeholders within the city who are going to be providing the capital. You've got your city budgets, you've got your citizens, there is the private sector, and then there is utilities and transport companies. So those are the identified sources of capital that people have come up with. But you can see that big yellow box, which is well over 25%. There is a large part of the environment that needs to be financed, and nobody knows where that money is going to come from. We want to help you access that through the private capital base. And indeed, a city fund or an SPV is one of the ways that we can do that. So we're certainly starting with that discussion today. But as Harry said, there are numerous other financial instruments, and we hope to educate everybody on those instruments in the coming few weeks. But starting, I guess, with the city fund and an SPV. Now, the benefit, I guess, of the city fund and SPV is that that allows you to establish a specific vehicle for specific projects to be put into. And in there, private investors can either invest directly. Indeed, corporates can invest directly. The city can invest some of the city's own funds. So it is a structure through which a lot of pools of capital can come together in order to finance a specific set of projects that sit on the other side of it. There's a very the similarities between city funds and SPVs are quite specific. SPVs tend to be the legal structure through which the city fund would sit in, although it doesn't always have to be that case. The SPV, you would allocate specific subset of your projects into that with a predetermined return, and investors would agree to invest alongside that specific set of projects and that specific return. A city fund potentially is a little bit broader than that, but equally you are still going to need specific projects. You are going to need an identified source of return in order to attract capital in any form into the city fund. Maybe the next page, Luke. So a few things that you really need to think about when you're thinking about a city fund or an SPV and setting that up. Project modeling and the financial structure around that are two of those, and Harry's going to go into that together. Again, to look at how you mobilize the capital, who are going to be the stakeholders who could potentially invest in the fund and the SPV, and what is the right rate of return in order to get different pools of capital interested? Is there different returns rates that would get people interested, and are we able to set those sort of returns rates individually? We obviously will be doing that in conjunction with the city finance specialists who will be starting in the next few months to work with the cities, and in terms of policy, because regionally you are going to have different policies that govern how you can set up a fund and an SPV, and you are going to have to be a little bit more aware of the specifics in terms of your own geographies when we do set those up, but we will come on to that later. So I guess just the last one from us, why Alison Lobb from BWB are you here talking to me about city funds? What are your credentials to having that discussion? So Luke, maybe if we just move to the next page. I guess Bankers Without Boundaries is a regulated entity. We are regulated by the Financial Services Institution, and we within that are all a group of ex-bankers who have performed financial advisory for many years. At BWB specifically, we have good experience with funds, and we have just pointing to 3 of them. So we did set up advise Milan on a transition fund that they looked at implementing in order to fund their climate actions. We are working on a completely different type of fund at the moment with the UN in terms of a tiger fund. So that is a fund which is raising money to help support the tiger population growth globally. And we also have our own funds that we do run internally. So BVF is a nature tech fund, which Bankers Without Boundaries do run. So 3 good examples there of completely different funds: city infrastructure, geographic infrastructure to support animal welfare, and our own private fund, which is looking at private nature tech corporations. So we have a lot of credibility in this space. We have a lot of background on how you set them up, and hopefully we'll be able to answer all of your questions around how you do that as we go through. Obviously, we work for the City Missions Capital Hub, and the consortium partners have an awful lot of experience in other areas as well in terms of the technical side of things that we will need to use in order to get the projects ready to go into a fund, but also in terms of the financial and economic modeling, how to help you think about risks and metrics on the other side of that. I probably will leave it on that one, Luke. The next slide just has the credentials of where we all used to work for. But I think in the interest of time, Harry, let me hand back to you and we can start on some of the more specific content.
Yeah, exactly. And I was just going to say I'm happy to cover that now. But I think what we want to get out of this, because we don't have all the time in the world, and obviously we're happy to engage on a sort of more bilateral basis with cities, but is that we're hoping to get across from this some of the definitions of the key aspects of what the city fund is. Obviously, we've had a lot of people to come across asking for bilaterals on these to clarify the elements of the composition, why they might be deployed, some examples of where they've done. So we thought it might be a good idea to pull this together as a sort of early conversation starter. So what we want to do is really show some of the use cases, define some of the aspects, run through some case studies, and then also give a few sort of technical aspects of the instrument. So, I mean, yeah, as we've had it identified, there's a significant gap that needs to be met, and a lot of resource that needs to be mobilized in order to meet this gap. And also, I think there are some other structures that are relevant, but this is one that keeps coming up, so it'd be great to cover. So if we go to the next slide, what is an SPV? So at its core, an SPV is a separate legal entity created for a very specific purpose, as Alison said, which is often used to isolate financial risk, transfer ownership, and then group projects into a bundle of assets. So it's really relevant. It's a legal structure, like a company. It's often used in, different sort of scenarios, both in public and private sector, but it's really relevant for city funds because it allows cities to undertake projects or investments without directly impacting their overall finances and helping to manage the risks and maintain financial liability. I guess in conversations with some city subsidiaries, for instance, transport companies that are run by the city, they've identified that there's a cost pressure that they're not able to meet due to limits on raising prices of their tickets, or due to a lack of being able to take on financing because of cost of capital concerns. And an SPV is one way that we've identified that through conversations, that actually being able to engage the city level alongside the sort of subsidiaries and some of the PPPs they work with. So hopefully that more or less explains what the overlap is between these, that will show roughly how that's actually going to be relevant for you. So there are three most common use cases. So if we go to the next slide, what we've seen is with government financing, which is obviously the first one and quite relevant for you, it's able to look at off-balance sheet financing. So using an SPV to have certain projects or initiatives which might directly impact their balance sheets. And by creating an SPV, a government's able to create a separate, can separate the financing of specific projects from its overall position. This can be really particularly useful when seeking to engage in larger scale infrastructure projects, and also ensuring that the risk mitigation is properly developed. So, a lot of ventures have got some uncertain outcomes and potential liabilities. So this helps with sort of broader financial stability and ring fencing the risks within the assets. For the second one, for the project financing, it's more sort of the way that it's done is loans that are specifically secured against either cash flows or an asset. So through the SPV here, this means actually having often a transfer of ownership and having collateral which is isolated and limited to the project itself, leading to more favorable credit conditions. So in this case, you can see an SPV is actually more of a tool as a part of financing than necessarily a city fund in itself, which is a much more sort of operating entity which the city can use to deploy capital in a way that suits their outcomes. And I guess something that we'd like to get across here is that often different investors, being either public or private, have got very different rationales and business cases that they want to engage with. So the city itself has got an obligation to the citizens, has got an obligation to obviously the climate city contract that you're operating in, the decarbonisation, whilst private sector, be it to the corporate or an investor, has obligations to shareholders and to the operations of its entity. And the idea that we want to get across is that aligning these can be done through, to a certain extent, city funds. If we go to the next one, we identified 6 main requirements of project financing when using an SPV. So generating of cash flows, ensuring planning of the investment project. So that could be actually looking at which stakeholders would be engaged when cash flows are going to be coming through when, and how much the quantity is going to be coming through to be able to support the level of debt that's required or the equity involved in it. The implementation timeframe of these are often, as the case with infrastructure projects, much longer term, 25 to sort of 30 years, and the projects are generally quite a lot larger. And this is due to some of the initial cost setups and also due to I guess some of the actual scale that's being tried to deploy. If we've seen the amount of cash that's missing in a lot of these funds and a lot of the cash that needs to be sourced, it makes sense, therefore, that this kind of thing needs to be at a much larger scale in order to manage some of the financing requirements, but also some of the project scalability elements. So we've included some, identified some examples of these, such as power plants, factories, energy, water treatment plants, roads, bridges, infrastructure facilities tend to be housed within these. If we go to the next slide, I've more or less actually covered some of these aspects, which are the sort of main functions of an SPV. The legal function of pooling assets, the contracting functions of risks, and actually ensuring that the project is ultimately clustered for stakeholders to join the activities and responsibilities at the appropriate time. But there is a third one, which is the organizational function. And I do have a case study which will talk through this slightly later, but there's a governance aspect to it as well, with how the SPV is managed, how it's incorporated, and then what the financing can be done to properly engage these aspects. So if we go to the next slide, you'll see this coming across in the sort of pros and cons. So the pros being that there are a lot of ways of organizing these, having people participate, and this is able to feed in with the governance. So I know that I'll show it on the next slide, but not. I'll just stay on this for a second. But the Hague was able to use an equity investment as a part of their participation to be able to maintain voting rights in the structure and have government oversight in something that would otherwise largely be a private sector enterprise. So I guess the idea here is that because the SPV is a fully functioning unit with its own governance structure, having the city involved in this often means that you're able to have some kind of leverage for the private sector and carrying out projects that can be identified, that have been identified in the investment and the action plan. So alongside that, it means that certain payments and aspects can then actually be leveraged to then, as put in here, if services aren't pulled through or if obligations aren't met, the governance structure can then hold people accountable. And there's a saying in English which hopefully doesn't translate too badly, is hold people's feet to the fire. Some of the cons behind this are, like I've said before, there's some additional costs for the transaction. A lot of that comes down to legals usually, and that's the same case with everyone that's doing it. There's often a long lead time in some of the projects, as is always the case with project financing, though obviously that depends on the advancement of them. And often in cases it's only beneficial for much larger projects. However, that is the point of where we'll get to with the City Fund as well. So I've got two case studies which I wanted to identify of how SPVs have been used. So if we go to the next one, we've seen an SPV deployed in Manchester for a housing retrofit, which was up to the scale of about 250 million, 235 million pounds. And it's been around for around 15 years, which has resulted in 1,500 refurbished council properties, multiple new houses and parks, and some green corridors created as well. And as I mentioned before with the Hague, the reason I wanted to identify this is because the small equity participation in this enabled a decision power to steer the process, safeguard public interest in the project development, and also ensure the balance of parties involved to be compliant with state aid rules, which were particularly specific in the Netherlands. And I think one of the things that identified, or I said earlier on, was that as with all of these public and private sector actors, there's a real alignment of incentives that needs to be done through the governance and through the returns profiles that obviously needs to be tackled and considered with these city funds and SPVs. And a lot of that can be a tiny bit complicated to get set up at the start. So hopefully that's something that we can help you with discussing, as a lot of cities have been asking about these city funds. So hopefully that's something that we can be able to support with. That more or less covers the SPV section of the presentation, but it's obviously the conversation's not over because we've now going to move on to, really excitingly, city funds. So city funds themselves, if we, I guess what I'll cover here is I'll cover more I want to give a bit of context behind the different incentives that are needed for investors and how that comes through in their own mandates that they produce. So I know that we've had bilateral conversations with some of you to identify what types of investors there are and generally how they structure products to be able to fit that risk appetite and to be able to fit their sort of return requirements, whether that's public through looking at a social return on the equity, or whether it's impact through looking at identifying the obligations to the impact that they've said, or whether it's much more of a private sector who is looking to increase their operations and improve their and develop their business cases. So if we go to the next slide, you'll see that we've laid these out on a sort of map. So you might recognize this slide because we've talked through it in different examples. So we've talked through it with introductions to the Capital Hub of which sort of investors we're engaging with and which we can help to engage with. But also one of the key things that's like worth identifying here is that when we consider some of the sort of standard private sector investors, we look at obviously the financial institutions which people consider to be investors, but we also look at the sort of corporates of the project owners and the way that they actually invest capital to engage. Now, each of these looks, like I said, at different instruments to engage in sectors they understand, clients they know, and also with return profiles that fits their sort of risk appetite and their return expectations. Now, the key idea of the City Fund that we want to get across is how you're able to align these multiple incentives in order to further some of the aspects that are in the Climate City contract. And obviously from the public side, just for completeness, we have governments, MDBs, state finances, both at a European level, all three at a European level, a national level, and sometimes even at a local city level itself. So if we go to the next one, what I've identified, or what we've put together here, is to show that really these different investors are happy to engage on a sort of general level with different forms of infrastructure that are relevant for their mandates that they've got through. So this is a quick example of what sort of projects they invest with different investor types. And a City Fund we'd hope to show would be able to align these incentives for the social return on capital with the actual return on capital. So you think here, for instance, investors who are from a private side to generally look at things with a little bit more sort of track record that fits their risk appetite, and they strategically deploy capital to focus on things that they've got a tried and tested intervention. In fact, a lot of the times early on, for instance, when investing in renewables, private sector investors were a little bit wary of some of the aspects behind this, and they did actually take advantage of public sector support, both in terms of policy, grant capital incentives, and tax incentives as well, to be able to participate. It's now a pretty tried and tested thing, and a lot of private investors are looking for these opportunities all the time, so it's less of a problem. But I guess when we look at where the money is missing, it's not necessarily on these things that private sector can already engage in, but it's the whole scope of where the capital is required in order to fit the bill. So on the next slide, what I've shown is that because there's often a challenging business case behind this, deploying and blending capital together often helps to address this challenging business case and address this lack of track record and the more challenging sort of risky business cases. So this is actually a structure called a tiered fund, which has been used previously in a City Fund. I've got an example of that later, but the idea here, without wanting to get too technical, because I understand that it's I understand that it's going to be very project dependent, it's going to be very city dependent. But what we're hoping to show here is that as different risk levels appear for different projects, for different sort of underlying projects within the fund structure, you're able to leverage the public funding for a different risk level through splitting, as an example, the purchasing of the fund or the participation in the fund into different risk categories. So, for instance, for private investors, they might look at buying these notes for the minimum risk piece. for more sort of, I've written in DFIs here, but actually, national banks or even areas aligned with public investment, how these can be leveraged by slightly riskier assets that are still fit to the mandate and still able to identify or work with their sort of cost of capital, going down to social impact and then actually grant capital providers as well. And the idea here is that the shares at the top are incentivized to join because they only suffer a loss to the extent that the lower tiers, or the Class C, Class B and A, are depleted themselves. So I guess, this is just one example of how a challenging business case can be overcome through engaging the different levels of capital, through deploying the different mandates discussed previously, to then actually create a much more scalable entity through a city fund, which can then actually be structured to do to the mandate that's required by the city and through the investment plans. So I've shown this again in the next slide to make it a little bit more clear, but fundamentally, each investor pool has got a different focus areas with different overlaps. And the idea is to leverage those different incentive structures to then create a scalable instrument. So a lot of sovereign wealth funds actually do this at a much larger scale. So deploying resources, leveraging the scale of private investors and limited partners to actually invest in things that further the needs of the sovereign. So in this case, that's looking at things like scaling health impact, scaling the political influence across the world, and participating in lots of different actual mandates which can be furthered by the sovereign. And there's the incentives piece here is finding the overlap of what investors are targeting. And like I said, for corporates or financial investors, it's ensuring that they meet the obligations of their investors underneath. And for governments and local authorities, is actually ensuring that they meet the obligations that they have to their citizens. For the next slide, what I've shown is I wanted to use an example of how city funds enable that scale through interventions across a city, rather than enabling the scale through the investor side. So to provide a bit of clarity, what we were looking there is more how the city fund engages the supply of capital. Now we want to look a little bit at how it engages the demand of capital. And it's those two-tiered pieces where we say, okay, where does the money come from and why is it engaged, to then how is it deployed and why is it deployed? So this is an example of, for the built environment, of something you might call an intervention specific fund. So this is looking at a portfolio described across different projects or interventions, which I've shown at number 0.2 on this. And apologies for all the boxes and arrows. I know that it's quite difficult to explain this over Zoom, and hopefully any questions we can address in another session. But each intervention here might have a different level of risk and a different business case potential. So Asen and I actually worked on a review of multiple built environment projects out in a Nordic city. And we found that, for instance, there was a really high level of or really effective results for installing a new door in multiple different areas because of the scalability, but also the cost savings and the energy use for the building were really effective. Now, if you categorize these sort of rooftop solar intervention, the heating insulation intervention, and then also maybe other pieces that you have there, you identify where the money needs to be used within the fund. And obviously, for that piece, grant-based funding, which I'm showing at number 3, can be used to create the initial structure, some of the technical costs for the fund. And some examples, I know people are using the Pilot City program to do this. I know that Eleanor offers some support for some of the projects as well, which can help to develop an idea of what these energy saving funds need to be delivered. A lot of feedback from investors as well is that some of the involvement in these structures, they would need to be able to create additional scale to be able to deploy these things at a much higher level. So what I've shown here at number 4 is actually capital being deployed on a city basis to be able to take advantage either through an intervention specific or a more city specific fund. And I will sort of glaze over this next one because I've spotted the time that we have here and want to leave a little bit of time for questions. But what I've listed here in the next slide is how waterfall return structure comes into these. So we might say that the tiered hurdle rate of return here, and a hurdle rate is more of a benchmark of what private investors might be expecting, and you can use it to align the incentives early on as a part of the negotiation to show what the sort of minimum return base might be. And when you think back to the previous slide where we showed the different forms of capital in there, how that capital can be leveraged to provide the return rates required to then deal with these different interventions at more of a city level fund. Understanding that this is reasonably theoretical and high level, but hopefully this makes a bit of sense as to how this sort of leveraged capital return, the leveraged capital that we've provided from the supply of capital, can then link to where this money is then deployed afterwards. I want to move on to the case studies. So we skip forward 3 slides. City Fund case study, great. So what I wanted to get across here is that there are multiple places or multiple times when this has been used to differing levels of scale, to different intervention specifics, and across multiple different geographies to deliver different, well, metropolitan climate funds. So we've shown sort of 6 high-level examples here with the Amsterdam Climate and Energy Fund, the London Green Fund, the Almada Less Carbon Climate Fund, the New York Energy Efficient Corporation, Sustainable Melbourne Fund, and actually the Toronto Atmospheric Fund. Each one has got a slightly different rationale behind this, and obviously targeting different outcomes. And fundamentally some really interesting structures that have been used to deploy them. The key piece here is that a lot of them have leveraged some of the public financing that previously available. So for instance, whilst this might sound a bit outdated now, the London Green Fund was actually capitalised with some of the EIB capital on behalf of the Greater London Authority. And it focused on waste, energy efficiency, decentralised energy, and social housing projects, which reached a scale of about £120 million. And we've also at BWB been involved with the City of London Climate Fund, some of the structure there, which is hopefully something that will be relevant later on for them as they actually start to go towards execution. I've done a slight deep dive into one of these, which if we go to the next fund, or the next slide and next fund actually, is the Green for Growth Fund. Now, the reason I wanted to share this is because it makes slightly more tangible what I said with the theoretical aspect of notes, A shares, B shares, and C shares. So this has been used in practice across multiple different countries. So what this is and the thing I want to get out of this is more the tiered risk sharing structure. So the fund was structured to say the 4 investment options introduced, notes, A shares, B shares, and C shares, which represented the different loss tranches and the different risk appetite of the investors. And it meant that the fund itself was increases the effectiveness of donor funding to align incentives and to sort of leverage the different risk appetites of investors to scale the fund itself. I have one more slide that I want to show you on governance, which should be here. Just to say that we sort of touched upon the governance piece when I was talking about the Hague Fund and how the idea is to, I guess, create a structure that allows different investors to participate whilst also aligning their structures. The 3 key ways of them being managed, or a fund being managed in general, that we've highlighted here, are the fact that it could be privately managed as a private enterprise to just manage its own risks and align the private objectives with the returns versus the long-term public objectives that would create impact. And this has been done before. What this doesn't have, however, is an overseeing public government institution other than necessarily providing the capital that's in there already. Then there's public fund purely, which is more aligning the fund's investments decision to long-term public objectives rather than a returns base. So the fund management is not necessarily comprised of investment professionals, takes a bit of time to get funding decisions and can sometimes delay the deployment of capital, but it is better aligned with the long-term public objectives. But there is a third structure which leverages the SPV piece alongside the City Fund piece, which is actually having key decisions from the, including investment, risk audit, remuneration, taken with input from city representatives, and actually having that blended capital structure, blended governance structure, which can, I guess, be professionally managed whilst also having the public oversight that's needed to align the objectives. From this, I'd love to also just hand over finally to, I guess, Asen to have any sort of closing words about it now that we've covered much more of the content. But from my side, thank you also for engaging. It's an interesting topic for us, and I'd love to catch up with any of you afterwards. But Asen, over to you.
Yeah, no, thank you, Harry. And just a few points from me, if I may, having kind of managed both a public-private fund, but also a private fund. And we keep hearing cities keen to go down the route of setting up a fund, and I'm sure quite a few of you appreciate that there's quite a few things to consider before you set up a fund. I generally have seen it again and again that people think if they put a fund together, they can easily raise a lot of money, a lot of capital. Just be very clear, what your mandate is, what's the focus. Kind of the more broad you keep it, the more difficult it is to pull in different investors, both on the private and the public side. The more specific you are in terms of the mandates and have clear visibility of how you're gonna deploy the money, the easier and the more chance there is that you raise more money. I saw a couple of comments in the chat. Capital is available. The capital need is even bigger than what many had expected, but yet capital is available. Just need to be very specific on the governance. Some of what we presented here may be a bit technical. I do recognize a couple of names. It would have been interesting to get a sense of how many of you are from the treasury or from the finance department within the cities. Very happy for you to share these slides with the finance individuals, and if there are additional questions or remarks, we're more than happy to pick up separately. As colleagues said, we've got practical experience of setting up funds. We've got also a few other partners in the consortium who've had that experience. So, the support is there. We've got the setup of the hub, which is a capital entity, a capital platform, just to make that clear, which will pull in different sources of capital. But obviously, city funds, SPVs, they're more kind of specific, if you like. And the whole idea is to leverage the local capital ecosystem, both on the public side, right? I know a lot of cities are asking, how can we access additional public funding? And can the label facilitate this, which is exactly the purpose of putting the hub in place, but also leverage additional money from the local capital ecosystem, so the two really can go hand in hand. Let me stop here. Are there any questions? I saw a few in the chat. I hope we've addressed them, but are there any questions from the audience? And there's no such a thing as a stupid question. So if you're seeking additional clarifications from the content we just presented, more than happy to address them now. So we've got one question in the chat. Is it possible to imagine the hub will allow on day to upload portfolio projects coming from different cities? So I mean, just now, I mean, looking at your questions, as I said, it's the online. It's an online platform in the sense that we'll have a website. Obviously, we're part of the Net Zero Cities platform, but the hub itself will be a capital platform that will facilitate money, both, as I said, public and private, to help you with your investment opportunities. So the projects or the investment opportunities that will be put forward by the label cities to the hub, you know, they will come from different cities. So the focus here is clearly all the cities that have the label have validated investment plans. So we need exactly how much money is needed, what particularly is needed for what the investment opportunities will achieve based on the city strategy and action plans will be presented to the hub, and through our support, we will get money for the implementation. Does that address your question?
I guess what I would add is the hub isn't necessarily just there as a platform. Its interface is not meant to just be digitally. We have numerous investor connectivity, and the way the private capital market works is very much not through an internet platform. It's through investor connectivity and very much through linking projects to the right investors who are going to do that. I think if you think about the private capital space, these aren't people who are sitting in their office scrolling through websites every day to see what projects come up that might meet their criteria. That's very much a face-to-face discussion that they're having with their trusted brokers and trusted advisors, and want people to bring them specific projects that meet specific mandates. So the best type of capital and the most efficient, and indeed the capital that's sticky and is going to stay with you through the entire project build, is not going to be capital that's sourced through an internet website. You know, the long-term capital, be it the sovereign wealth funds, be it the pension funds, be it the asset managers, they aren't just sitting scrolling through platforms, which is why we've had to build the structure to enable that face-to-face dialogue come in, because then hopefully the capital that we will bring in will be much more sticky. When you're dealing with citizens, it's a lot, that's where you do need the platforms, because you need to go en masse out to people. But even then, that comes with an awful lot of marketing. People aren't naturally going to be going to a platform. And I mean, this one of the municipalities in London actually launched their own crowdfunding platform a few weeks ago. But again, it's not just about launching that and expecting that the people who live in that council are going to suddenly start donating. You have to pay for marketing. You have to still get in front of people, sell the story to them. So that's what the hub's going to bring, in addition to just having this, you know, front end. So I just want to be quite clear on that. We are here as a value plus service. We're not here just to provide a medium to advertise projects on the other side.
Yeah, no, that's, I mean, absolutely. That is definitely the case. You know, the platform is not, sorry, the hub is not an online platform, just another EU program or initiative where you can upload a document hoping that you'll get access to significant capital. I think there's much more value add, especially if we want to pull in the wide array of capital available both on the public and the private side.
Michael,
yeah.
question there, I guess, on the pros and cons of setting up an SPV or just coordinating directly with investments without the SPV. Obviously, doing the latter of those is far less legally rigorous and intense. And I guess that's the takeaway on an SPV. When you set up a city fund or an SPV, it's there for life, for want of a better word, whereas a project-specific investor funding is purely there for the life cycle of the specific project. So from a city point of view, it's much less administrative to try and fund city project by project. Whilst that might sound counterintuitive, once you've set up a fund, you've got to live and die by that fund, by the reporting requirements, and by the investor relations and all of that has to go on for the lifetime of that fund. So you would be able to fund, and indeed we are encouraging to cities to look more project by project basis, and can indeed help in terms of PPPs, which again will be another topic of discussion that we will talk on one of these workshops in coming weeks. But setting up the PPP and indeed finding the private investors, the private infrastructure funds, utilizing money that the EIB want to lend out for big private projects, we can absolutely and will help with that on a bottom-up basis. And there's definitely arguments, pros and cons for both. But I mean, administratively, the setting up of a city fund and the requirements that come with that, especially if you're going to take private capital in, is quite a big ask. So actually project by project financing tends to be a little bit quicker to actually execute on, and a little bit more of a simplified process to come round. The costs of setting up a fund or an SPV, is there an approximate amount of money that is needed to make it worth the costs? That's a good question. I don't have a specific answer for you, but I mean, in terms of regulation and reporting requirements, and indeed generating returns to make the fund self-sufficient, because you would want the returns to pay for a lot of those costs as you go through, the development of it. There would be a minimum amount of money that needed to be raised at a more institutional level. I mean, I don't know exactly what that number would be, but I would guess about 100 million would be the smallest amount that you would want to be taking on all of that administrative burden for. I don't think it would be worth it for anything less than that. Not least, you could probably find that financing at a more project level, rather than necessarily trying to do that. And so I guess that the point there, which is worth flagging, where that might come into play, is where people have a lot of smaller projects, but to your point, it's not worth it setting up a fund just to execute those. Where hopefully the city finance specialists and the hub will then be able to help is by saying, well, actually, if we take these 10 Spanish cities, all of whom have one very small project in the same sector, we suddenly have a Spanish sectorial fund which can fund every project, but actually when we put all 10 together, it's of a much bigger scale and is able to therefore be financed. So I think that's the other reason why the hub will certainly come into play, is by making regional funds or sector specific funds, in order to be like, actually, if we can go to investors and say, this is a residential building retrofit fund, it's not just Spain, it's Italy, it's Portugal, you've got bits from every geography across Europe, we can absolutely do that. But that allows us to scale up the project to make it big enough to actually make it worth the while to do that sort of investment process.
Yeah. I think it also depends on the size of the city as well. Obviously bigger cities have a much bigger pipeline. Just going back to what I said earlier, right? I mean, I've seen many cases where people just go ahead setting up a fund or an SPV, trying to raise tons of money without having clear visibility of what the money will be spent on. And that has to be well defined, very clearly articulated. If you approach many investors and say, I just need 100 million because I've got 20,000, I don't know, buildings to renovate, that's not going to be credible enough when you engage with investors. You need to be quite clear in articulating the mandate of each SPV. We've got another question from the city of Malmö. So let me just read it out. It would be interesting to hear a little more about the management of increased OPEX, which may follow the implementation of new solutions/transitions, not just focus on CapEx, or is the funds also able to handle OPEX? Thank you for today. I mean, so I can offer an answer of this. It is, again, it depends on the mandate and the utilization of the pool of capital that you're looking to raise, right? That's what a lot of the investors will ask. Are you looking for implementation capital, or are you looking for maintenance capital, right? When you do your structuring on the investment opportunities, you should consider the OPEX as well, in addition to the CapEx, because what I've seen in my experience, a lot of times this is not factored in, and then you run out of capital to maintain the assets, which creates additional anxiety with investors. So when you start creating your investment opportunities or your capital needs, please factor in the OPEX. So that's a very good point, because the last thing you want is that you raise 50 million or 100 million, and in 2 years you run out of money to manage the assets. I don't know, Alison or Harry, if you want to add anything on that point.
Nothing from my side additionally. I guess I guess it is part of it is like actually there's the initial capital expenditure on some projects, but some of it does actually carry over into OpEx. But there are also some general OpEx benefits as well to some of the investments that go through. So a classic thing is the difference between energy source being burning commodity value with a very high OpEx continuously in order to get the energy benefits. Now that works with oil and gas, whereas a solar PV has got a much higher upfront capex and a lower sort of continuous OpEx until the replacement of some of the batteries and some of the PV units. And I guess the point there is that a lot of money is needed up front, and potentially some less over the course of the life cycle. But obviously, it's very project dependent on what's bundled into there, and these kind of OpEx and capex structures need to be managed carefully against the potential cash flows of it. And that's a key aspect of project finance, is mapping those cash flows against who pays what when and what you can expect to be participated at what point.
And there are certainly ways that the upside and the downside can be capped. So you could, for example, have a portfolio which you think has a returns profile of 10%, but in order to fund potentially less profitable or less bankable, fundable projects, you could say, actually, we're only going to return 6% because the other 4% we're going to keep will be used to fund some of the lesser attractive things within our portfolio. So there are ways that you can do that in order to contain capital within the structure to ensure that the sort of OpEx and ongoing CapEx is sort of funded as well, both on the upside and on the downside.
Okay, I know we're 3 minutes over time, and I already see people dropping off, so they're probably joining other calls. Thank you all for joining us for this first webinar. If you have, we're going to share, I'm sure we're going to share the presentations with Net Zero City stakeholders. So, but if there are any additional questions or follow-ups, more than welcome to reach out. So thank you and have a good afternoon.
Yeah, good to see you all.
Bye.